So you have zero revenue. You are quite literally just digging holes in the dirt right now, but somehow you are sitting on a $1.1 billion war chest, actively refusing to sell your future product. It is, it is just the ultimate flex.
It really is.
You are listening to Earnings Unscripted, where we unpack what really happened in today's earnings. Today is March 4th, 2026, and we are looking at the Q4-25 results for NexGen Energy, ticker NXE. So they are pre-revenue trying to build this massive Rook I uranium mine in the Athabasca Basin. But the financials look wildly different this quarter.
Yeah, completely different. Look, just to set the baseline, they reported a net loss of $42.8 million, which sounds like a lot until you realize it was a $129.2 million loss last quarter. And the earnings per share came in at -7 cents, up from -23 cents in Q3. But the real story is that cash pile. They went from 306 million to over 1.12 billion in Q4.
Right. And quick reminder before we jump completely into the deep end, this is not financial advice, just our personal take on the numbers. But wait, how do you lose so much less money when your business is still making $0?
Welcome to the magic of paper math. That entire swing in their net loss was essentially just the US to Canadian dollar exchange rate.
Wait, really?
Yeah, they hold massive convertible debt denominated in US dollars. So the exchange rate shifted, and suddenly they book a $1.8 million gain compared to a $95 million mark-to-market loss in Q3. It is literally just paper valuation. The actual operational spend ticked up about 22% to $6.6 million, mainly office and travel, because they are aggressively hiring to build the mine.
So the underlying business didn't magically get cheaper. They're just hedging currencies on a spreadsheet, which is wild.
Exactly. But the market seemed to digest it okay. The stock actually had a pretty nasty pre-market drop before the call yesterday, hit a low near 1180, but once the numbers came out this morning, it caught a decent bid, chopped sideways mostly and closed slightly higher at 1277 today. They basically unwound the early panic.
Which makes sense, because if you read the actual transcript, there is this incredible human story under all that paper math. We're constantly hearing about this massive mining labor shortage in North America, right?
Mm-hmm. It's a huge bottleneck everywhere.
Right? Well, NexGen posted 65 job openings recently, and they got over 4,000 applicants.
Wow. Okay, that is not normal.
Not at all. It's mostly local tradespeople who are totally desperate to stop doing fly-in, fly-out shifts at the Alberta tar sands. They want to come home to Saskatchewan. It's such a grounded reality compared to the derivative math on their balance sheet.
Look, having your pick of local talent fundamentally changes the risk profile for a mine build. You eliminate contractor unavailability, which is like the biggest inflation risk right now. And they're going to need every advantage because getting this physical rock out of the ground is going to take a lot more than just goodwill.
All right, let's get into the details on that because they're playing a very specific, almost dangerous game with the broader uranium market right now.
It is a massive game of chicken. You look at traditional mega mining projects, right? They usually survive by pre-selling their future production to secure bank debt. But NexGen is doing the exact opposite.
How so? Because normally you need those guaranteed contracts just to convince anyone to lend to you.
Right, exactly. But because they stuffed all that equity onto the balance sheet with the recent global offering, they bought themselves the luxury of patience. They do not have to beg banks. The CEO, Lee Courier, was super explicit. I have his quote right here. He said, "Our strategy is to be the most levered company in the world to the future price of uranium. We currently are, and we will maintain that."
Wait. So they are actively turning down buyers, even with big tech throwing money at anything nuclear right now?
Absolutely. They broke even on early contracting at 3.5 million pounds, but they purposely capped their ongoing contracted limits to just 2 million pounds a year. And, well, they will only sign if the buyer agrees to pay the spot market price at the exact time of future delivery. They refuse to lock in a fixed price today.
So they are keeping the ceiling wide open for a world where uranium hits, what, $200 a pound?
Yeah, which Courier actually defended on the call. He pointed out the previous high for uranium was $136 back in the mid-2000s. He said that is over $200 in today's terms, and, quote, the likelihood of that occurring is very real. And the data backs up the tension. Spot utility purchases by hyperscalers jumped 85% year over year, while legacy miners are holding back legacy miners sold roughly 60% less volume to the spot markets.
Wow. Okay, so producers are tapped out, AI server farms are getting desperate, and NexGen is just sitting there holding the bag?
Well, they are holding a bag, but not the one you think. This is where it gets structurally bizarre. They are a pre-revenue developer, but they're actually sitting on 2.7 million pounds of physical existing natural uranium.
Hold on. Can I jump in? A mining company went out and bought the thing they are supposed to be mining?
Yep. They used unsecured debt to just buy it on the open market last year. It is sitting on the balance sheet right now as a $341 million asset. It functions as a synthetic treasury protection, but frankly, it is a huge psychological flex. They are signaling to the market that even the miners think holding the physical rock is vastly superior to cashing it out.
Which is a brilliant narrative move. But logistically, where do you put $341 million of yellow cake? Is it just piled up in an office building in Vancouver?
No. And that is actually the quiet, potentially brutal risk in all this. The filings note that this strategic inventory is collateral, but it physically resides with a third-party storage provider called MMC Cap. And the whole arrangement relies entirely on what they call a book transfer.
Oh, okay. So if that facility hits insolvency or something goes sideways with their business, what happens?
Then NexGen could potentially lose legal ownership with very limited recourse under standard limits. You end up being an unsecured creditor, fighting in court over a spreadsheet entry, not a physical barrel of uranium.
Jeez, that is terrifying. So they have this brilliant financial leverage on paper, but the actual physical rock is locked up in someone else's system. It's like they're stitching the parachute while falling, but they bought the silk from a guy who might go bankrupt.
Exactly. It's an incredibly sophisticated financial operation for a company that fundamentally just needs to dig a giant hole in the Canadian shield.
All right, so they have over $1 billion in cash, a mountain of paper uranium, and they're basically starving the utilities to force prices up. It feels like they hold all the cards right now. So where does this leave them heading into next quarter when the regulatory hearings wrap up?
It leaves them waiting on the Canadian Nuclear Safety Commission. That is the final federal hurdle. Once they get that green light, which is expected right around now in Q1, they finally pivot from the spreadsheet to physical earthworks.
And sinking a shaft is where the risk gets very real, because paper math does not actually dig through bedrock. But wait, hold on. Do they actually have enough cash to start that without hitting a wall?
Yeah, they do. Management gave some really direct guidance on the capital deployment. Courier noted the first 12 months of construction will only burn about $300 million. So out of that $1.1 billion, or, well, $1.12 billion technically, they have a massive buffer. He said they have anywhere from now to 18 months from now to conclude the final project financing.
Okay, so they basically bought an 18-month runway where they do not have to talk to a single predatory lender, which means they can just sit back and watch big tech completely panic over power supply. It is honestly kind of beautiful when you step back and look at it.
Right. I mean, the hyperscalers are out here pitching this infinite AI super intelligence future, but those servers rely on baseload power infrastructure that just does not exist yet. Courier actually dropped a quote on the call that I thought was incredibly sobering. He said, "It is likely that it will take decades for mined uranium supply to meet existing demand, let alone the significant growth anticipated."
Decades. Jeez. You really feel the absolute disconnect there. Silicon Valley operates in fiscal quarters, and these miners operate in geological eras.
Well, geological eras and foreign exchange rate swaps. Let us be real about how they fixed the net loss this quarter. But yes, fundamentally, they are betting that the raw physics of energy will eventually break the patience of the tech billionaires.
Which sets up quite the staring contest. We will see who blinks first when those contracts start dropping next year. But either way, I'm just glad those local Saskatchewan tradesmen finally get to go home to their families.
That is a perfect human note to end on, honestly. If you want these earnings drops to just show up for you, follow the show. And as a quick aside, this podcast is an AI-assisted project, meaning the voices you are hearing right now are entirely AI-generated, just to see how technology can make these complex reports a bit more digestible. We would love your ticker requests, so just email us at earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for hanging out. We will catch you next time.
See you then.